Hello, I'm Kimberley, Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face-to-face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley, Dondo, Digital Content Manager, and in this episode, I'm joined by Ken Maxwell, Director at John Lamb Hill Oldridge. So Ken, thank you so much for joining me today. Could you give us a bit more of an introduction into yourself and how you got started in financial services?
Yeah, hi Kim, nice to be here today. Thanks for having me. So I'd originally started my career in wealth management and then moved over to 5-6 years ago, moved over to specializing in protection for clients, and typically for clients, high net worth, ultra high net worth individuals who need protection, certainly in terms of preserving their wealth. And as part of their planning for passing on to next generations. And I work with a company called John Lamb Hill Oldridge. John Lamb started as an IFA about 60 odd years ago. And a big part of that has been protection, so life insurance. And we're based in London. And as I mentioned, that's what we specialize in dealing with protection policies, typically to assist or provide liquidity for inheritance tax for these sort of clients, which is a big concern for a number of clients.
Okay, so talking about those clients, so can you highlight the unique risks that high net worth and ultra high net worth individuals face compared to like the general population when it comes to their protection?
Sure. I think for these types of clients, it's more a matter of impact for them. Certainly in terms of sort of inheritance tax, it's much more of a factor for the high net worth and ultra high net worth clients as it is for general population, and that's a factor due to the size of their wealth, and also due to the fact that the nil rate band of 325,000 that we all have available, which would not be subject to inheritance tax, and also our residential nil rate band of 175,000. So if you had a married couple or civil partnership, you have up to about £1 million, where really IHT is not a factor. But for a number of these clients, their net assets are significantly higher than this amount, and the nil rate band has been frozen for a number of years, and looks like it will continue to be frozen for several more to come. And I think therefore a lot of these clients are looking at the impact that those taxes are going to have on their wealth and passing it on to the next generation. And it really comes down to a matter of liquidity. So, especially for a particular type of client, say the sort of landed estate type of client, their main sort of focus is passing on the estate intact to the next generation. And therefore, they have a big issue with inheritance tax, where on death there would be, a 40% charge on parts of their assets or parts of their estate. And therefore, they're focused on providing liquidity to pay that tax, which is where we deal with these clients on a number of occasions by placing a life insurance policy, which would provide the funds to pay that tax on death. So I think it comes down to the fact that tax for these type of clients is a higher impact on the estate, and therefore it needs to be quite a focus for them, and it is a focus.
Yeah. And what are some common misconceptions that you come across when it comes to wealth protection?
Good question. One I've come across a few times is a lack of understanding in regards to gifting assets and there being a 7-year tail for inheritance tax on those gifts. So a couple of, quite a few times actually, whereby certain people have thought that their plan is just to gift their assets, a week before they die, and then that solves the problem because it's out of their estates. And it's not, there is a 7-year tail for inheritance tax post that gift. And therefore, that doesn't work. And it's obviously just, making that clear and making, people understand that isn't a solution. Gifting is a very good solution for, for dealing with potential tax, certainly IHT. But it needs to be done either early on or maybe insure those 7 years with, through life insurance, you can insure that 7 year, so you can manage the risk, and then therefore it's still effective. But, typically, and also having said that, gifting, if you're close to death, shall we say, that also writes off the idea of life insurance, because as you can probably imagine, not too many life insurers are keen to take a risk if they know someone's close to death. So I would say that's certainly a misconception that I've come across a few times. Another one would be gifts with reservations of benefit, particularly when it comes to property. So that's where mum and dad or whoever is thinking they're gifting to the children, and typically what they would do is they would gift, and they would have to, say, a house, they would gift, and if they wanted to continue to live there, they would have to pay, not only have they gifted the assets to the children, but they also have to pay a market rent to the kids. So an actual market rent rather than just a low rent that they've come up between themselves. And that rent gets reviewed, or has to be reviewed every 3 years. And that's an awkward conversation when you ask mum and dad, sorry, you're now going to have to pay me a higher rent on the property you've already given me. That can be a bit tricky. So I certainly think there's certain misconceptions around gift of reservation of benefit, and also the recipient that who's receiving that rent is going to have, there's tax on that as well as the recipient. They're going to have to pay income tax on that. So there's other factors to take into to account. And ultimately with those sort of scenarios, we would say life insurance is a much cheaper option, whereby you can retain the asset, and it's less likely to fail, because life insurance will pay out on death and cover the tax, so you can retain that. And also, I suppose with that as well is you've got to bear in mind that as the donor or mum and dad get older, they're going to need money for care. Care costs are very expensive. Yeah. I was going to say staggering. Yeah, they are. So you've got to take these factors into consideration when you're maybe doing gifting a property and paying a rent. Are you going to need that money, and can you afford to pay increased rent further down the line, and what have you? So there's a few factors to play in there, and I think ultimately one of the biggest ones is that a number of people don't have a will. A will is probably your best and part of planning. That should be your first part of planning. Make sure the assets are going where you want them to go and how you want them to be treated. So I think a lot of people don't see the importance of a will, and I think that's a misconception, and I think they really should as first port of call, and also making sure it's up to date. So because things change over the years, and just making sure that's still relevant to what you want to happen.
I mean, it's an awkward conversation to have. think I tried to have it. Well, I did have it with both my parents. They talked to me about it when I was like in my mid-20s, and then I didn't care because that felt like something that was so far in the future. And then now I brought it up, and both of them were like, why do you care so much? What are you trying to, they start to get a bit suspicious.
Yeah, well, I think when we're young, we don't have any dependents, and maybe we're single. It's less of a factor, I suppose, because you're not really thinking, where does this money need to go? And unfortunately, you tend to have less assets as well that you have to worry about. But as you get older, if you do have any dependents, or you have people reliant on you, and you want to make sure that those assets go to the right places, then it's important. So I would say a will is really, really key to part of the planning.
Yeah, definitely. And how do you approach building a comprehensive protection strategies that address both financial and personal aspects of high net worth and ultra high net worth clients' lives?
Well, we as a company, John Lamb, we work as really a part of a team typically for clients. So our clients will have their other professionals providing certain parts of advice for them. Whether it be their lawyers or their accountants. So we work as part of a team, and we work with those other professionals to get an overall picture of what the client's situation is, and therefore what therefore identifying their needs. And as part of that, again, just reiterating what I said before, a will is really important, and also making sure that certainly when it comes to again like inheritance tax, we would always look at, making sure you've got the will, make sure the assets will pass, or the liability will trigger on second death if you're a married couple or in a civil partnership. And therefore, that's when the tax is going to trigger, and then we would base a protection policy around that. But really, it's one of the key parts that we will always do is discuss potential gifting, and also budget. Like, what is your budget for gifting? What can you afford to gift? And what can you afford to spend if you're going to protect yourself from the inheritance tax during those period? What's your budget to spend on life insurance, for example, to cover that? And it might not actually be affordability. It's also what you want to spend on, just because you can afford it doesn't mean you want to spend it on life insurance. So I think really discussing early on potential of gifts in the future, what the budget is. And I think once you have that in place, you can then put a strategy around that, because then you can say, well, the estate, there's certain parts of your estate that will always be, you're going to hold on till death. So maybe insure those, but we can then, we know that you're going to gift certain amounts prior to that, so we don't need to insure the whole amount. But I think we keep very close contact with their other advisors, which is really helpful to give an overall best strategy for the client. So we keep in contact with everyone, so we know what the plan is, how the relationship of that client and their family is made up. And who's likely to inherit what assets, etc. So it's really just about speaking to the clients at the beginning and discussing what are their objectives, and then also identifying the liabilities and trying to match those up together. So we have clients who have several different types of policies to protect different aspects of their lives when it comes to tax, ultimately, which is really what we do.
Yeah. Having a cohesive network is obviously very important.
Makes our lives a lot easier, and in the end of the day, it's much better for the clients if we're all talking, certainly.
Yeah. So you've talked about some of the strategies that you have in place, but are there any others that you would recommend for safeguarding physical assets, like real estate or any other valuables?
Yeah, I think, firstly, I think this type of client, the ultra high net worth client, having a good insurance program in place, and I don't mean life insurance, I mean sort of general insurance for theft and damage, especially when, if you're talking about, art collections and property, property and art collections, having a good insurance program in place to protect against those possibilities is very important, especially if the value of these assets is significant. We don't do general insurance, but I would say it's a very important factor, and a lot of our clients will have that in place, wisely so. And even things such as having very good alarm systems on their properties, for art collections, and especially if if clients have really nice art collections, which they do, they might want to actually see the art and enjoy it rather than have it in the vault or have it in a bank or safety deposit, whatever it may be. So it's nice to be able to actually enjoy it in your home, then and insure it. Then we've got a particular client that they have, I think, they're quite a nice art collection, and the general insurers insists, as part of the insurance program, they insist that there must be a person on the property at all times.
Wow.
So if it's left unmanned completely, I'm not saying that's a security guard, I'm just saying there must be a person in the property, then it would default. So there's for the type of clients that we're talking about today, then certainly get a good insurance program. And then really for if you're safeguarding against tax, again, certainly for real estate, it's a good life insurance policy. And that's it doesn't matter if the property if the property in the UK, if it is property in the UK, whether it's art or whether it's real estate. It doesn't actually matter. It will always be chargeable for inheritance tax if it's a UK situs asset, regardless of whether the client's non-res or non-dom. Even if they're abroad, if they're UK situs assets, there will still be a liability for inheritance tax on those assets. And especially if, say, always just using art collection as a complete example, although it's more movable art rather than a house. If it is based in the UK, their property in the UK, then for that protection, for tax, then you would look at life insurance, in my opinion.
Yeah, and we're also in quite an advanced digital age. Things are constantly changing, and we're constantly online. So I can imagine it's the same for some of your clients as well. Is cybersecurity something that you take very seriously, or how are you utilizing that to benefit your clients?
We take cybersecurity very carefully. We take all I have to admit, this is probably out of my remit. But what I do, especially, I know we as a company take all the precautions, all the usual process and steps and safeguarding in terms of systems for financial information, or any information really, like many companies do, or at least should do. It's always a concern, and I think it's a growing concern. And all you can do is keep putting in as many steps as possible to protect yourself from those issues. And same for clients. And I think if they're worried about sensitive financial information for themselves, or as you say, any cybersecurity, I would always say for these types of clients, do your best to avoid social media. Don't have yourself out there on all the various sources, Facebook and Instagram and X now, I think it is, rather than Twitter.
Yes.
Trying to avoid those if possible, and also just always worth having hopefully it's never needed, but always worth just having a good reputational lawyer just in case anything goes wrong, or something's leaked that you didn't want it to be leaked, or whatever it may be. It's always worth having a good reputational lawyer there to handle any issues that may come, which we obviously always hope never do, even if it's not. So it's an area that's not I'm not particularly experienced in, but it's obviously a concern for people, and understandably so.
Yeah, I mean, a lot of that is very good advice anyway. So I think it makes sense to me. And I guess my next question is, what role does insurance play in wealth protection strategies? And could you share some examples of solutions that you have tailored to high net worth and ultra high net worth clients?
Sure. Yeah, I think, insurance provides, as I sort of touched on, it provides the cash flow to pay the tax when it arises, for inheritance tax. And, clients may have a short-term issue, medium-term issue, long-term issue, depends. And those timeframes they differ or depend on different clients. And I suppose, on age, ultimately, if you're a 30-year-old, short, medium terms, probably short term 30 years, you're up to 60. If you're a 75-year-old, 7 years is short term, because, at that certain aspect in your age. So I think it's, as I say, the tax is to pay the tax, the insurance is to pay the tax on death and provide the liquidity. And to give you some idea, or an idea of a couple of, case or ideas of clients that we've looked at or might see, there's, where we have mum and dad live in a house, a nice, quite a large house, and the plan is to gift it on to their son or daughter. But, the son or daughter's only in their early to mid 20s. And the plan has been made and agreed with mum and dad that they will move out of the property and gift to their child in 10 years' time. And that's the game plan. The child will be that much older, and also the child probably doesn't want to live in a country pile somewhere at that age. They want to be somewhere closer to activity. So what we did in that particular case is we've put in place a 17-year term policy. So essentially it was a 10-year term to cover the liability as it stands right now on death there. And then 7 years, so when they gift in 10 years' time, we put in place a 7-year tapering policy. So we can match as the liability for inheritance tax post the gift starts to fall away after year 3, we can match that with the policy. So it will start to reduce as the tax reduces. So therefore the cost of the insurance reduces also with the premium. And also it makes much more sense in terms of cost-wise to insure now rather than in 10 years' time when you're actually making a gift, because the liability exists right now. So insure now for the next 10 years, and actually then you've got a 7-year tapering policy bolted on to the end to cover the gift. So whilst mum or dad are young, that's we did that policy, and that's worked out really cost effectively for the client. And also when mum or dad are young and healthy, or youngish, should we say. So that worked out really well. We see quite a lot of where maybe stepmom is having to gift to, stepmom's basically being forced to gift. In this particular case, it was in excess of £5 million that stepmom was having to gift to a stepdaughter following dad's death. And everyone really wanted that 7-year policy in place. The trustees and the life assured, what have you. Certainly the trustees wanted, because they were appointing assets away from a trust to the stepdaughter as part of this gift, and they wanted the policy to cover the tax, as ultimately it would fall back on the trustees if stepmom had died during those 7 years without the cover. I mean, they do have. They would, again, I'm not a lawyer, but they would have essentially right of recovery against the beneficiary or against the estate. But easier said than done if stepdaughter's already spent the money. Much safer option just to insure and make sure if it does happen that the money's there to pay the tax. So seen that a couple of times where it's stepmom's gifting to stepson or stepdaughter or both, or even some cases to the mistress even. So it's being forced to gift to the mistress, and again the trustees want to make sure that tax is covered in case anything happens over the 7 years. So I've seen that, and it's difficult. Those sort of scenarios are quite difficult because stepmom's not really wanting to have to go through this and gift away, but sort of being forced to do so. So with those particular cases, it's just how you've got to handle them sensitively, and just keep communicating with all parties to make sure it goes as best as these things can.
Yeah.
And I think there was another one which was quite interesting, whereby a client was moving offshore.
Okay.
And he had shares in a property company, which he was making a gift to his child, quite a significant amount of shares in this company. And he was moving offshore because what he wanted to do is pay quite a significant dividend, which he could do pretty much tax-free from a different jurisdiction and continue on, and planning to live there for the foreseeable. So it's quite good tax planning by his advisors. But the gift of the UK Citus assets would still be chargeable over those 7 years. So we insure those 7 years. But it's understanding again with his other professionals what he's doing and why. And then why there's a liability. Because the other thing with the insurers, life insurers and insurance providers, that they want an insurable interest. I.e., there has to be a potential loss from that. If dad or mum gifts the amount and they die within the 7 years, then there's an inheritance tax trigger. So they would offer cover on that basis, rather than Ken decides that he wants 10 million of cover, but Ken actually doesn't have any assets, and his income doesn't justify that level of cover. That they won't cover. So it's understanding where the risk is, and again communicating with their other advisors as to what their plans are, because that was timing that correctly was important. So yeah, a few areas where we've looked at, and there's a whole host of them, and it's interesting for us as well, because it's trying to think about how you can design the policies to fit their needs, because there's there might be a lot of moving parts to their life, often are moving parts to their lives. So it's working out a program that works best for them.
Yeah. And touching back on those family dynamics, I find it so interesting. I think the only thing that I've seen that talks about or shows the potential dynamics for high net worth and ultra high net worth individuals was Succession, which I guess is accurately named because it was all about succession planning, even though, spoiler, in the end, he didn't really actually really plan. Again, going back to that will conversation, very important. But even that character didn't have that in plan. So I imagine there's a lot of guidance that you try and provide to these clients. So what strategies do you give those clients, or how do you talk to those clients about how they can then talk to their families?
Yeah, I think you just spoiled that, Kim, because I'm only in season 1 of Succession.
I'm so sorry. I'm so sorry.
I'm a bit behind the curve on that. I'm only just starting to get through it, but it's very good.
It is so good, honestly. I don't think I told you the character, but yeah.
I know you did. It's all fine. I think like anything with this, is the key element is getting the serious buy-in from patriarch or patriarch. Whoever has the wealth, until they are convinced as to what they want to do, you can make no plan, because you need to have them on, decided on what they want to do, and without that, it's very difficult to move further forward. Once they have decided or come to an agreement or pretty sure they know what they want to do, then you get everyone else involved, children to talk, so they know what's happening, and they know that they can then plan. And that's, to be honest with you, that's the key factor is getting everyone to talk communication, everyone communicating, rather than the children not actually having a clue as to what's going on. If you can get everyone in the same conversation, then that's going to be the most effective for guiding them through that. But I think as maybe succession, I don't know, but I think with that, from even the first, series, the main character is pretty much where the wealth sits, or as far as I can tell so far. And once, until they have decided what they're going to do, and if you can get them to sit down and actually get them all in the same room to communicate and continue to communicate dialogue, then that's your most effective tool. And then you can plan around that, whatever it may be. You can then make a plan and advise them on areas that they need to discuss. I mean, family governance is, it's fast growing space in the professional world, and it's evolving as well. It's not really an area we focus on at all, but there's a big market out there for professionals who are advising on that and helping clients with their family governance and going through the evolving cycle with that, because it does change. But I think it's pretty crucial to get the best result for families. So everyone is, there's no disappointments, or there could always be disappointments, but at least no real shocks at the end. And then you sometimes see these legal battles, in papers where brother and sister, one of them's inherited it all, and the other one's now suing them because they convinced them to change their will. I mean, who knows? But I think if everyone knew where they stood earlier on, then that can only benefit the clients and the family.
Okay. Yeah, I think you covered, I was also going to ask about estate disputes, but I guess you covered that, and communication, I guess, is the main key. Yeah. Are there any other steps that people can take to make the process much smoother?
Well, make sure, have your select your advisors around you carefully. Make sure you've got the right advisors to handle different parts of your planning and your estate, and keep them in the loop as to what you want and what you're doing. But outside of that, in terms of what we're doing, we communicate with the clients and the other advisors to put in place protection for as part of their planning. We'll put in the protection as that element to it, but. Outside of that, really, from my experience with these clients, is just getting them to talk and focus as early as possible, because they've got, these clients have busy lives, and this isn't, they probably don't really want to spend too much time. Not all, some will, but not all want to spend too much time looking at the planning on something that may be years and years down the line. But I think the earlier they do it, the better, which can only help with a smoother process.
Yeah. And so the financial landscape and regulatory environment are constantly changing. So how do you ensure that your wealth protection strategies stay relevant and effective over time?
Yeah, so we as advisors, we remain up to date and relevant in terms of we do continuing CPD. So we're constantly doing our CPD each year, continual professional development, update on topics and exams each year, a certain amount of hours as a bare minimum. Going to a number of seminars, tax seminars, what have you, hosted by other professionals outside of what we necessarily do on life insurance, to know what's happening out there in the wider market, hearing from the regulators themselves, as to any changes there. And as I mentioned, we work very closely with the other professionals, the lawyers and accountants, bankers. So we hear and we see what they're doing with clients, and we speak to them about their strategies. So that really helps us to hear of anything kind of new that people are doing with their planning. And we can make sure that we're sort of up to date on changes. And as well, certainly for what we do specifically, we run a renewal and valuations service. So we, each year we will contact the client and offer them a review of their existing policies. We'll always say to clients, if things change materially, then do let us know, because either their assets have increased significantly, therefore they have a larger liability they might want to insure, or their assets have decreased, in which case they've had a lot of nice holidays and their liability may be less. But we'll run that renewal service and valuations to make sure that clients know what they've got in place to cover tax with life insurance, and also whether there's anything possibly better out there in the market that we could replace that policy with. The market does change. In life insurance, not very fast, I must say. Policies can change with certain insurers. So we keep up to date on those with constantly speaking to the insurance providers, hearing what's happening in the market, and then speaking to other professionals in the wider market and attending seminars. So that's how we keep up to date.
Yeah, and I know that you said things move slowly with life insurance in particular, but are there any emerging trends or challenges that you foresee happening?
Emerging trends. Well, I mean, I think we are seeing, and we have seen a lot of gifting, gifting assets, and we do see that regularly. So certainly clients are aware of that. And challenges, I mean, the difficulty certainly for us is, we're focused on tax, and you can only put in place a plan for what is there in front of you, so you can see it as the current tax environment, or if the tax rules change, inheritance tax, if that got abolished, there might be some other tax that comes in to replace it, depending on the government in power. But it's just adapting to what to those changes and staying active, really. So you do it. It's a constant. Unfortunately, it's a constant process. It's a continuing process, whereby just because you've done something now, it doesn't mean that things can't change in 10 years' time, and you need to revisit it. So again, it's just keeping in touch with your advisors, whoever they may be, to make sure that what you have in place is still accurate. Really.
Yeah. And finally, what advice would you offer to high net worth and ultra high net worth individuals who are seeking to enhance their wealth protection strategies?
That's a simple one. Get advice.
Yeah.
I really would recommend getting good advice and accept the fact that you're going to have to pay them probably lots of money, but just accept the fact that you're gonna pay for the advice, but it will save you, inevitably it will save you significant amounts of money in the long run, rather than not paying for the advice. Pay for those, whether it's your accountant, your lawyer, your banker, whoever it is. Pay for the advice and find good advisors. Have around you and stay in contact with them. That's the best. And let them know of any changes or any thoughts of what you're planning to do. I think a lot of clients and possibly a lot of lawyers would argue that clients who maybe are coming to the UK from offshore will often contact them after they're already here, rather than saying this is the plan and therefore giving the advisor the time to put certain steps in place which would make it less costly for the client. So speak to your advisors if you have thoughts about future plans and moves. Just communicate with them. But have good advisors around you, because it is worth it, even though it might cost in the short term. It will save you in the long run, in my opinion.
Yeah, definitely. I'd rather pay a little bit now rather than have to have some astronomical thing happen later on and be kicking myself. But yeah, that makes sense.
Yeah.
Well, thank you so much for speaking with me today, Ken. That was a very interesting conversation.
No, pleasure, Kim. Thanks for having me. Hopefully I didn't bore you too much with some of the topics, but
I find it fascinating, especially. Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.